A bank run refers to a situation where a significant number of clients of a bank or any financial institution withdraw their deposits simultaneously due to concerns regarding the institution's ability to pay its debts. As more people withdraw their funds, the probability of default increases, which, in turn, can cause more people to withdraw their deposits. In some instances, the bank's reserves may not be sufficient to cover the withdrawals. Welcome to Money Mindset, where we provide educational resources on money, personal finance, and investing. In this video, you will learn what a bank run is, and we will give some examples of bank runs. If you're serious about enhancing your financial future, make sure to hit the subscribe button and like this video if it was helpful to you. Bank runs occur when a large group of individuals withdraw their funds from a bank due to apprehension that the institution will exhaust its reserves. Such an event is usually a result of panic, rather than the bank's actual insolvency. However, if the fear-fueled bank run persists, it can eventually lead to genuine insolvency. To minimize the risk of bank runs, financial institutions are required to maintain a minimum amount of cash reserves, either in a bank vault or with a central bank. Banks also have a set limit on how much they can store in their vaults each day to ensure security. However, since banks generally keep only a small portion of deposits as cash on hand, they must enhance their cash position to fulfill the withdrawal demands of their clients. One of the ways in which a bank can increase its cash on hand is by selling its assets, often at a lower price than their actual worth if there wasn't an urgency to sell. Such losses on asset sales can cause concern, triggering more withdrawals. Examples of bank runs. Bank runs have been associated with the Great Depression in modern history. Following the stock market crash in 1929, depositors in America were anxious and began to hoard physical cash, causing a chain of bank runs on thousands of banks in the early 1930s. The U.S. government established various regulatory measures in response to these bank runs, including the Federal Deposit Insurance Corporation, FDIC, which currently insures depositors up to $250,000 per banking institution. Despite these efforts, bank runs still happen. Examples of recent significant bank runs include Silicon Valley Bank, Washington Mutual Bank, WaMu, and Wachovia Bank. Silicon Valley Bank. In March 2023, a bank run triggered by venture capitalists led to the collapse of Silicon Valley Bank. The bank disclosed a need for $2.25 billion to strengthen its balance sheet, and within one business day, customers withdrew approximately $42 billion. As a result, regulators seized control of the bank's assets and closed it down. With assets worth $209 billion as of the fourth quarter of 2022, Silicon Valley Bank's failure is ranked as the second largest in history. Washington Mutual, WaMu. In 2008, Washington Mutual experienced the largest bank failure in the U.S., with approximately $310 billion in assets. Several factors led to the bank's collapse, including a weak housing market and rapid growth. Moreover, WaMu suffered a run when customers withdrew $16.7 billion within a span of 2 weeks. Following the bank's failure, J.P. Morgan Chase purchased it for $1.9 billion. Wachovia Bank. Wachovia Bank was closed down when depositors withdrew more than $15 billion over a period of 2 weeks, triggered by the bank's announcement of negative earnings results. Wells Fargo later acquired Wachovia for $15 billion. The majority of the withdrawals were made from commercial accounts with balances exceeding the limit covered by the Federal Deposit Insurance Corporation, FDIC, bringing those balances just under the FDIC limit. Preventing bank runs. Governments took various measures to reduce the risk of future bank runs in response to the financial instability of the 1930s. One major step was the establishment of reserve requirements, which mandate that banks hold a certain percentage of total deposits as cash reserves. Additionally, the U.S. Congress created the FDIC in 1933 to insure bank deposits, following the numerous bank failures of previous years. The FDIC's goal is to uphold stability and public trust in the U.S. financial system by providing up to $250,000 of insurance per depositor, per account for FDIC-backed banks. This ensures that if a bank fails, your deposits are safeguarded up to that amount. Sometimes, banks must take a more proactive approach when confronted with the possibility of a bank run. For example, they may temporarily close to prevent large-scale withdrawals. In 1933, Franklin D. Roosevelt declared a bank holiday, calling for inspections to determine the bank's financial health, so they could continue operating. What is a silent bank run? A silent bank run refers to the withdrawal of funds by depositors in large volumes via electronic means, without physically visiting the bank. These types of bank runs are comparable to regular bank runs, except that funds are withdrawn using ACH transfers, wire transfers, and other non-physical methods that do not involve the withdrawal of physical cash. Why is a bank run bad? Bank runs can trigger negative feedback loops that may result in the collapse of individual banks, as well as systemic financial crises. Typically, banks have a limited amount of cash reserves that are insufficient to cover the total amount of their deposits. If a large number of customers demand their funds simultaneously, the bank may not have enough cash on hand to return to its depositors. A bank run occurs when bank customers rush to withdraw their funds, either physically or online, due to a loss of confidence in the bank's financial stability. In extreme situations, bank runs can lead to the collapse of a financial institution, as seen in the case of Silicon Valley Bank's closure in 2023. To mitigate the risk of losing money in a bank run, it is advisable to keep the amount of your deposit below the FDIC insured limit of $250,000 per depositor, per insured bank. If you need to deposit additional funds, you may consider opening an account at another bank to receive the same level of protection.